Hi there. From this video, we will study Chapter 4. Chapter 4 title is, I don't remember exactly what it was, but it should be something like finishing the accounting cycle or something like that. The major topic in this chapter is the closing entry, I would say. Okay, before talking about closing entries, we need to distinguish permanent accounts from current accounts. What are they? Let me explain in this video the difference between permanent and temporary accounts. Okay, to explain that, we need to recall what we've studied for financial accounting. What were they? We have income statement, right? Okay, let's begin from balance sheet. We have balance sheet, and let's say that we have economic resources, which is called in accounting assets, totaling say $1 million, and out of $1 million, liability is say $0.8 million, and equity is $0.2 million. Okay, it is for as of December 31st of 2021, let's say. Okay, when you prepare your balance sheet, you also prepare your income statement, right? And this is December 31st of 2021. And let's say that 1 year has been passed. This is December 31st of 2022. Okay. December 31st of 2022. Okay. When a year ends, you prepare the income statement for a period between January 1st of 2022 and December 31st of 2022, right? When you prepare income statement, unlike balance sheet, you need to make it clear which period you're talking about. We studied it in chapter 1. That is, balance sheet is like a picture at a specific second, specific moment in time. What is your status, right? What is your status of your aggregate economic resources, your debt amount, your own wealth, right? It's like a picture at a specific moment. Unlike balance sheet, income statement is describing what happened over a certain period, right? And then we say that, let's say that for the year was good, and our sales was say $500,000, and all the expenses are $0.2 million, giving you net income of $0.3 million. Then, as you've studied so far, you prepare at the end of the year another balance sheet, right? This is your year-end balance sheet of 2021. Now you are preparing balance sheet at the year end of 2022, right? One thing that students easily confused about is, in accounting, is ending balance sheet is the same as your beginning balance sheet of the year. Again, ending balance sheet of the last year, yesteryear, is the same as beginning balance sheet of this year. Like, how much do you have last night before you go to bed in your pocket? Did you have $100? That money should stay there when you wake up this morning, right? Your money in your pocket last night, the ending balance of your cash at the end of yesterday should be the same as beginning balance of your cash this morning, today, right? So this is the same as beginning balance of assets, equity, and liability at the beginning of 2022, right? So what we can say is beginning from equity, 0.2 million, we have increase in equity as net income, 0.3 million. That gives you a new equity, 0.5 million, assuming that nothing else had happened, right? Which is 0.2 plus 0.3. And liability is the same, assuming that it is the same. And your total asset is 0.8 plus 0.5, which is 1.3, right? Okay, so far so good. Now we've finished another fiscal year, 2022. Then let's assume that what happens? This is the year, New Year Day of 2023. Again, what we've prepared is for 2022 year end. This is the new year, just 1 minute passed. Okay, then when just 1 minute passed, what would be your year beginning balance sheet? As we've discussed, it should be the same as before, right? Your balance sheet as of January 1st of 2023, when 1 minute passed, come on, it should be most likely the same, right? Your balance sheet should be the same as this balance sheet, right? Then as of January 1st, 2023, 12:01 a.m. What's your income statement? I am asking you, how much did you make as your sales, as your expense, as your net income? How much did you make for the year 2023? Sounds silly, right? When it's only 1 minute past. You say, come on, why are you asking this silly question? The answer is clear. You made nothing over the 1 minute. At the year end, zero. Expense, zero. Net income, zero. Right? What I am asking you is, that's right. What happens is, when you begin your new year, your new month, when you begin your new quarter, you need to zero out your sales, your expense, and therefore net income. You need to zero out these items. You need to zero out these items, meaning they are temporary. Accounts, which need to be zeroed out whenever you begin a new period. Okay? Oh, cool. We begin from the zero basis every year. Can you do the same thing for balance sheet items? Like, can we zero out our liability every year? Cool, right? No, you cannot. These balance sheet items, assets, liability, and equity, they are permanent accounts. You cannot zero out each year. Okay, let's summarize. Permanent accounts, what are they? Assets, liabilities, equity. Items are all permanent accounts when temporary. Let me be specific. When I say equity, I'm talking about owners' capital. When temporary accounts include sales or revenue. I told you we are using sales and revenue interchangeably. Expenses. And one more thing, owner's drawing. When you are asked, how much money did you withdraw from your company's account? As an owner, how much did you withdraw? Your question should specify during the last year or during the last quarter, right? Without specifying this period, the question is sort of vague, right? Therefore, it is like sales and expense. Owner's drawing is another temporary account. Okay, there is one more temporary account, which is called income. Summary. What is that? We will discuss it in the next video. Okay, based on these differences between permanent accounts and temporary accounts, we will build up so-called closing entries.